are your hosts. Beside me is the Undersecretary of the Department of Budget and Management, Margo Salcedo.
And co-hosting again today is none other than the Managing Director of the Bangko Sentral ng Pilipinas, Tony Lambino.
Good morning, Margo.
Good morning, Tony.
Good morning, everyone.
And we are so excited. It seems just like yesterday, Tony, that we were here for the first ever post-SONA Philippine Economic Briefing. And today, we all welcome you to the second post-SONA Economic Briefing.
This is the second post-SONA economic briefing of the President Ferdinand R. Marcos Jr. administration with the theme Agenda for Prosperity, Economic Transformation Toward Inclusivity and Sustainability. Today's event will serve as a platform to elaborate on the President's economic pronouncements during yesterday's SONA. The economic team will be providing us updates on the government's commitments and accomplishments vis-a-vis the country's economic blueprint, the Philippine Development Plan 2023 to 2020. We will also be joined by representatives from the private sector and multilateral organizations who will share their views on the SONA and the country's socio-economic agenda.
Before anything else, we would like to acknowledge the presence, of course, of the members of the Cabinet, the Diplomatic Corps, with Monsignor Alessio Deriu here representing Archbishop Charles Brown. And we would like to also welcome the esteemed members of the financial institutions and the financial community. So without further ado, let's kick off today's program with a message from Bangko Sentral ng Pilipinas, Governor Eli M. Remolona Jr.
Colleagues in government, friends from the banking community, partners from the private sector, ladies and gentlemen, magandang araw po. It's my pleasure to welcome you all to the second post-State of the Nation address and economic briefing of President Ferdinand Marcos Jr., themed Agenda for Prosperity, Economic Transformation Toward Inclusivity and Sustainability. Our economy recovered from one of the world's longest and most stringent lockdowns to stage a remarkable recovery, one of the fastest in the region. Part of the reason behind this economic resurgence, I would say, is the strength of our banking system. Unlike in previous crises, our banks formed part of the solution rather than part of the problem. This is in part due to our work in ensuring financial stability. Our challenge now is inflation. Fortunately, the BSP's inflation targeting framework has served us well in the face of unusual supply shocks. We continue to focus on our mandate of price stability and have dedicated our resources and attention in pursuit of this goal. Our models tell us that inflation will be within the target range of 2 to 4% by the fourth quarter of 2023. This is the range that we think is ideal for an economy like the Philippines when it's growing at full capacity. We also face increased digitalization in both our banking and payment systems. This presents opportunities for efficiency, competitiveness, and inclusion. We're mindful and we manage the attendant risks to ensure continued trust and confidence in this increasingly digital economy. We want to bring more Filipinos into this financial fold so that as many of us as possible can share in the fruits of economic progress. In all this, collaboration between the public and private sectors is crucial. We need to work together toward an economy that is strong, stable, sustainable, and financially inclusive. I'm sorry that I cannot join you in person, but our Deputy Governor, Francis Tequila, will represent the BSP in the panel discussion. Thank you very much, at mabuhay po tayong lahat.
Thank you, Governor Remolona. Please know that we are broadcasting live on PTV4 and live streaming on the Facebook pages of RTVM, the Presidential Communications Office, DOF, DSP, NEDA, PBM, with sign language interpretation. And we are also live streaming with simultaneous interpretation in Cebuano through the BSP Cebuano Facebook page, in Ilocano through the BSP Ilocano Facebook page, and in Filipino through the BSP's Filipino Facebook page. To open today's discussions, may we call on stage Finance Secretary Benjamin Idiokno, and Nomura's Managing Director and Chief Economist for Southeast Asia, Mr. Yuben Paracueles, for a fireside discussion.
Thank you, and good morning, everyone. Before we start the chat, I would like to invite Secretary Ben Jokno to provide his opening statements.
Thank you, Ruben. Ladies and gentlemen, good morning. Today I will discuss the country's fiscal performance and outlook and the policy tools we need to pursue to sustain the Philippine economy's growth momentum. The Philippines is one of the fastest growing emerging economies in the region, with much promise of growth in the years ahead. And this is amid a fragile global economy. In 2022, the economy grew by 7.6%, the highest in the last 46 years. This is followed by a robust Q1 2023 growth of 6.4%. This year, we expect the economy to grow between 6 to 7%, then pick up the pace to 6.5 to 8% from 2024 to 2028. The pillars that hold up the strength and resilience of the Philippine economy are built on a solid fiscal framework, guided by the medium-term fiscal framework. To recall, the framework's goals are to attain a national government deficit to GDP ratio of 3% by 2028. That's where we were before the pandemic. Debt to GDP ratio below 6% by 2025 and around 51% by 2028. And sustained infrastructure spending at 5 to 6% of GDP annually. Our consistently strong fiscal performance, as well as improving revenue generation and spending efficiency, brings us closer to these goals. From January to June this year, revenue collections of the national government reached 1.9 trillion pesos, up by 133 billion pesos, or 7.7% year on year. Tax collections grew by 7.5%, while non-tax collections grew by 9.1%. Our stellar performance was the result of higher economic activity and efficiency gains from the digital transformation of our revenue agencies. The digitalization of the Bureau of Internal Revenue and the Bureau of Customs have continued to maximize the government's revenue potential, simplify taxpayer compliance, and improve the ease of doing business. Now, sustaining revenue collection requires a simpler, fairer, and more efficient tax system, reinforced by a combination of tax policy and tax administration measures. Reforms in the pipeline include Package 4, or the Passive Income and Financial Intermediary Taxation, a VAT on non-resident digital service providers, and excise taxes on single-use plastics and pre-mixed alcoholic beverages, which are expected to be implemented starting 2024. Higher economic activity and increased investments will bring us to even greater heights. The policy environment for foreign direct investments is the most open and liberal it has ever been. Aside from the economic liberalization measures which have effectively opened many sectors, such as retail trade, renewable energy, toll roads, airports, telecommunications, and shipping, to 100% foreign ownership, the Philippine government is sharpening its public-private partnerships or PPP policy tools. This will allow us to engage the private sector more effectively in the funding and implementation of high-impact infrastructure flagship projects, which will significantly enhance the quality and pace of infrastructure development in critical sectors. Furthermore, the recently enacted Maharlika Investment Fund will serve as a vehicle for growth, as an additional source of funding. The MIF is expected to widen the fiscal space, reduce reliance on official development assistance in funding big-ticket items, and some target investment
For those here domestically, but also offshore investors, which I speak to a lot, being based in Singapore. So I'll start with the revenue side, so just under the MTFF. And congratulations, revenue collections have been holding up this year, 14.4% of GDP. That's pretty strong. And under the MTFF, revenues are projected to reach 17.6% of GDP by 2028 from 15.3% this year. So I think that's ambitious. How do you get there? Is there scope for more revenues to be raised on a more permanent basis? Is tax administration improvements going to be enough to get to that goal along with revenues?
Thank you, Ruben, for that question. You know, every president has a fixed term. It has a beginning and an end. And in the Philippines, president has a 6-year term without re-election. So you got to do what you can do within those 6 years. That's why as early as the first month of the Marcos Jr. administration, we designed what is called the medium-term fiscal framework. And so that's our North Star. We want to be, as you mentioned, where we want to be by 2028. Luckily, we inherited a tax system that is superior to what they inherited, the previous administration inherited from the previous one. So that said, the tax system that we inherited is a good one, but it's not a perfect one. Nothing is perfect, right? So I think for the first 3 years or 2 years, we can afford to just rely on administrative measures. But down the road, we will continue to reform the tax system, make it even better, and that's why I mentioned some measures that we intend to do. The single tax on single-use plastic, higher tax on sugary beverages, tax on any. And these measures were also mentioned by the President, by the way, in his State of the Nation address. So on top of increasing administrative reforms plus digitalization, the President mentioned that, we have some measures that we have actually lined up. In fact, I have roughly estimated what we can collect additionally from the two tax measures. Between 2024 and 2028, it will amount to about 1 trillion pesos.
Okay, so interesting. So I think that needs to be emphasized, the sequencing. Tax administration measures at the beginning and then complemented with the measures when they get passed through Congress. Okay, so that's the revenue side. On spending, I want to ask how crucial are the reforms on pension payments of military and uniformed personnel, and when are you targeting that to be implemented?
That reform on military pension is going to be a game changer. Okay? This, I said, this has been an elephant in the room. Previous administrations don't want to talk about it, recognizing it's difficult to push, but this president, having been elected with a majority of 60%, okay, this, by the way, this is the first time the Philippine president has won more than 50%, okay? Because there, usually we have several candidates, and you can elect a president with only 25% voters, okay, voting for the president. This president was elected by 60% of Filipino voters. And so he said, yeah, we have to address this issue once and for all. Otherwise, it will have a catastrophic impact in the future, right? So this military pension reform will be, as I said, game changer. It will open up a lot of fiscal space in the budget. If my numbers are right, 2024, we have allocated something like 300 billion pesos. 300 billion, that's approximately $6 billion for the military pension. Now, how soon will this be implemented? I think we are pushing for this. The military pension reform is part of the top priority legislative agenda of the president, concurred in by Congress, and we expect this to be passed before the end of the year, and so it will have an impact as soon as January of next year.
Okay. Wow, that's soon if it's going to happen this year. Can I follow up? I know you've been doing the rounds and doing consultations with the stakeholders. What has been the feedback so far?
I think so far, as we explained to them, that this is really for their own good to make the pension system more sustainable in the future, and I think they are very resilient. There are three types of beneficiaries from this reform. Those who are already retired will not tax them, more or less, because that's like a contractual obligation to them. Those who are in active service will be asked to contribute gradually to the system, and those who are going to be recruited for the first time will pay the full amount of but that's basically the way it will be structured. We have the treasurer and my several USECs have been going around and explaining to them, and so far I think the results of the consultation are very encouraging.
Okay, I want to move to credit ratings, the road to A. I know Fitch just recently put back the outlook to stable from negative, and Moody's was in town recently with discussions from the policymakers. What is your sense of the likelihood that there'll be more upward pressure on the ratings? What are these ratings agencies looking for to get to that?
I think it's much more difficult to get an A upgrade, right, from triple B plus to A. But that's still our goal. Our goal is still to what we call road to A, and so we expect to have that A rating by before the end of the president's term. Actually, Japan already has A minus for us, right? For China, the Philippines is triple A rating, but we want to get A rating from the three major rating agencies. I think they are still looking for. They do not doubt our ability to service our debt. I don't think so. So they're looking for more structural reforms that will maybe make our fiscal position stronger. And I think with this military pension reform, plus the right sizing of the bureaucracy, plus more tax reform, I think we'll qualify for A rating.
Okay, that's clear. Moving on to infrastructure, which the president also mentioned a lot in his SONA yesterday. And on the funding side, so you talked about the MIF. Can you just give us a sense of how do you expect the MIF to accelerate the infrastructure implementation? And given that it's only starting out, how soon do you realistically expect the impact to be felt?
Okay, let me give you a background. Under the previous administration, I look at the I joined the previous administration, I look at our infra as a percent of GDP. For the last 50 years before the Duterte administration, we were only spending something like 2%. That's why we suffer in comparison with our Asian peers. Okay, so I said we cannot sustain this. We got to increase our expenditures for infrastructure, and that brought about what I call the golden age of infrastructure. I started that, and it became build later on. So the previous administration spent something like 5 to 6%, and they delivered despite the crisis on that. And I think we should have a cycle of maybe the next, from the previous administration, the next 20 years should be, we should continue to build, okay? Now, previously, under the previous administration, when we came in, we don't have ready to implement projects. But, project development is kind of takes time, right? Project ID, evaluation, detailed engineering, so forth. Luckily, this government has immediately, that's a list of ready-to-implement projects, some 194 priority projects worth 8.3 trillion pesos. We need a lot of money for that. I look at the funding source for this 8.3. About 55% will be ODA, Official Development Assistance. 10% will be through the budget, and then 30% through public-private partnership. But we need these projects done as soon as possible. So the Maharlika Fund will be an additional avenue for funding this 194 and counting, because we continue to develop new projects, as I said, for the next 20 years, okay? So that's the source of funding that Maharlika can provide us, and it's a different form. It's no longer borrowing. It will have less stress on the budget because there will be equity contribution for this build program.
And in terms of the timing, when do you see that starting to have an impact on some of these projects?
Okay, the Maharlika bill was signed into law a few weeks ago. The law says we have 90 days to prepare the implementing rules and regulations, but immediately after the approval by the Senate of the bill, we started the preparation of the IRR. So we expect the implementing rules and regulations to be available by mid-August, or at the latest, last day of August, and then we expect this to be organized, appoint people in the right places by around September. And so I think the Maharlika will be off and running by early next year.
Okay, thanks. I guess I have time for two more questions, if that's okay. One is more for financial markets. I get this question a lot from our clients on the currency. So the government is very clear in its prioritization of building infrastructure. But what that also means is you probably need a lot of importation for capital goods, which could increase the current account deficit and therefore could put some pressure on the currency. So from your perspective as DF Secretary, but also BSP Monetary Board member, how does the government strike that balance?
Well, the peso right now is in a comfortable place, but we are actually shooting for what we call competitive peso, right? We don't want it to be too strong nor weak, right? So again, current account surplus right now. When we were not spending too much on infrastructure, we have a current account surplus. Remember that. So the peso was appreciating at that time. Now, but because of the needs for infrastructure spending, we might have some current account deficit, but that's a good way of having a deficit because you are investing in infrastructure, which will grow the economy, expand the capacity of the economy. Plus, we now have a steady source of foreign exchange. Before, we don't have the remittances, which easily brings in something like 30 to 32 billion US dollars annually. We have the business process outsourcing. Used to that used to be not available to us. BPO is bringing the same, approximately the same amount, and growing. I think I'm very bullish about our BPO prospects. Plus now foreign direct investments are coming in, and also tourism. So with all those steady source of funding, plus we have a hefty gross international reserves. Our gross international reserves is in the neighborhood of 7 to 8 months worth of imports. The rule of thumb is if you got 3 months worth of imports, you're okay. So with all those, I'm not worried about the possible peso depreciation.
Okay, thanks. And final question for me on the MTFF, just going back. So the target is 3% of GDP fiscal deficit by 2028. How open are you to the possibility of allowing slightly higher than 3% if, for example, the economy is facing a lot of external headwinds, even though that might mean that it might be more difficult to keep debt to GDP at less than 60%?
I've seen I've been in government for too long to see the folly of stopping the infra whenever there's some problem that you pointed out. No, I won't stop the infrastructure spending because slowing it down will only have negative consequences. Like there will be many unfinished projects, and you prolong the completion of some projects, which would then change the calculation of that net present value, the internal rate of return, and so forth and so on. I think once you start a project, you got to make sure that you finish that project. Okay? And therefore, when you make a plan, it's not going to be a straight line. There will be some adjustments along the way, and so I'm willing to maybe increase the deficit if necessary, as long as we can continue our infrastructure projects.
Yeah, I guess that also means that infrastructure and better quality spending.
Of course, we have to make sure that the quality of spending is retained all the way.
Okay, I think that's all the time we have for this chat. Thank you very much, Secretary Jokno, for the candid answers.
Thank you very much, Finance Secretary Benjamin Diokno and Mr. Paracueles, for that very engaging and very encouraging. I hope that it brings in even more investors now, that wonderful discussion. Thank you so much. And may we kindly request Secretary Diokno to please stay on stage as we proceed to our panel discussion.
With the President's SONA yesterday and the fireside chat that just happened here in PICC, we have been provided a better sense of the administration's economic plans and priorities. And now, for the first panel session, we will hear straight from the economic officials their plans on how to further transform the country into a fast-growing and forward-looking economy.
To give us more details, let me now call on stage our key economic officials. And please join Secretary Diokno, starting with NEDA, National Economic and Development Authority Secretary Arsenio M. Balisacan. Bangko Sentral ng Pilipinas Deputy Governor Francisco G. Daquila Jr. and the Department of Budget and Management's Principal Economist, Joselito R. Basilio.
Good morning again. Good morning, sirs. Thank you for joining Marco and I for this panel discussion. Let's start with a short opening statement from each of our panelists, starting with NEDA Secretary Arsenio Balisacan.
everyone. Complementing what we heard earlier from my colleague Sec Ben, the Marcos administration wasted no time formulating a sound development blueprint and creating an enabling policy environment supporting strong economic recovery and sustained growth momentum in its first year of office. President Bongbong Marcos quickly set his 8-point socioeconomic agenda, which served as the framework for the Philippine Development Plan 2023 to 2028 and accompanying regional development plans, providing us a development strategy roadmap in the medium term. To improve our economy's competitiveness and signal our country's openness to business, the government worked to create an investment-friendly policy environment through the issuance of the implementing rules and regulations of the amended Public Service Act, the revised IRR of the Build Operate Transfer Law, the amended Joint Venture Guidelines of the National Economic and Development Authority, or NEDA, among others. Furthermore, following a whole-of-government and whole-of-society approach, President Marcos and his cabinet convened the NEDA board and its cabinet-level committees, the Legislative Executive Development Advisory Council, the National Innovation Council, and the other interagency committees to assess and approve 20 high-impact national and regional projects, harmonize legislative priorities, and formulate policies in line with the objectives contained in the PBB. Such efforts resulted in our economy's robust recovery and return to the high growth norm, sustained improvement in our labor market indicators, and a continued downtrend for inflation. So what can the investor community and the public look forward to in the coming years? To ensure that we remain on track to meet our goals and recalibrate our strategies as necessary, we, NEDA, in coordination with other agencies, will monitor and evaluate the implementation of our development roadmaps. We will likewise monitor the progress of the government's infrastructure flagship projects, or IFPs, and ensure that concerned agencies take appropriate steps to resolve implementation constraints and ramp up our country's infrastructure drive. The government will create and promote an enabling policy and regulatory environment conducive to investment, innovation, and high-quality job creation. In line with this objective, we will continue to strengthen our public-private partnership, or PPP framework, and facilitate the efficient assessment of PPPs. We will also enable a dynamic innovation ecosystem through the policy and advocacy initiatives of the National Innovation Council. Of course, we remain committed to monitoring critical socioeconomic indicators and undertake rigorous analysis for evidence-based policymaking as we tackle emerging issues. We will take action and coordinate our efforts as we push for legislative executive priority measures supporting the development agenda. Through these initiatives, the Marcos administration will bring our economy closer to one that is prosperous, inclusive, and resilient, aligned with our long-term vision of providing a firmly rooted, comfortable, and secure life for all Filipinos. Thank you.
Thank you so much, Secretary Balisacan. And now to give his insights on where the Bangko Sentral ng Pilipinas now stands and how our economy stands, we welcome now the message of Bangko Sentral ng Pilipinas Deputy Governor Francisco G. Daquila Jr.
Morning to everyone. I will provide some updates on key developments on areas within the purview of the BSP. Now, let me start with our very short discussion of the dynamics of inflation. Last year, inflation spiked across the globe, mainly due to supply chain disruptions related to the pandemic, as well as to brewing geopolitical tensions, and that has not spared emerging market economies, including the Philippines. And this has prompted central banks in both advanced and emerging economies, including the Philippines, to raise policy interest rates, which consequently tighten global financial conditions. The good news is that in recent months, headline inflation has started to decline. So the latest number that we have this June is at 5.4%, significantly down from its peak at the start of the year. And this is due to easing supply side constraints, lower global oil prices, and the policy actions undertaken by the BSP. And that is illustrated in the left panel of this chart, which shows the inflation outlook as coming from our forecasting models. And so our latest baseline forecasts indicate that inflation could average at 5.4% for this year, which is above our inflation target range, but it will go down to 2.9% for next year, as can be seen in the right panel of this chart, which is comfortably within our target range of 2 to 4%. While we expect inflation to average above the target in the first half of this year, as can be seen again in the left panel, in the June monetary policy meeting, we are seeing inflation will continue to decelerate through the third quarter of this year and then to settle within target by Q4, barring any new unforeseen shocks, especially coming from the supply side. Thereafter, inflation is projected to decelerate quite close to the lower end of the target in the first quarter of next year, largely due to base effects and the likely deceleration in both global oil and non-oil prices. Now, in the following slide, I want to emphasize that that deceleration is due also in large part to the BSP's policy response amid the price pressures and the ensuing portfolio rebalancing, which influence fluctuations in capital flows and exchange rates. As can be seen in this chart, we have actually been the most aggressive among the central banks in the region, and the BSP has raised its policy rate by a cumulative 425 basis points from May of last year until March of this year, before taking a prudent pause during the last two monetary board meetings. And we have also let the peso move in line with market fundamentals. While the sensitivity of inflation to the exchange rate has remained low, and that has happened after we shifted to inflation targeting and after we have let the market determine the broad direction of exchange rate movements. The key concern is anchoring inflation expectations. And there was a point when during the second half of last year, when the Fed was quite aggressive in adjusting its policy rate, when it was introducing some volatility in the exchange rate. And that has been addressed by the prompt monetary policy actions of the Monetary Board. So we are confident that the policy rate adjustments, as well as the years of implementation and enforcement of the BSP's comprehensive policy tools and regulations, will not result in financial imbalances as the Philippine banking system continues to stand in a position of strength. Key banking indicators are summarized in this slide. And they will show, for example, that in the first quarter of this year, bank profits have actually grown by almost 35% year on year. Deposit growth has reflected the sustained confidence of the public with an 8.2% year-on-year growth as of end May of this year. And the non-performing loan ratio has actually gone down to 3.5%, again as of end May. So we see this continuing the robust performance of banks, as evidenced by all of these key indicators, and that we see banks remaining well capitalized, well managed, and well governed, giving us confidence that the policy rate adjustments were done without risking financial stability. Now, having said that, we will remain vigilant in monitoring international developments and their potential impact on the domestic financial system. And we want to assure that the BSP remains well equipped to provide support to the domestic banking system against the impact of external shocks. So let me summarize and end with the following key points. First, that indications of our previous monetary tightening has exerting its impact on the economy, along with the projected return of inflation to target in average for next year, has given the BSP's Monetary Board cause for a prudent pause. However, as has been emphasized in the policy statements following the decisions of the Monetary Board, the BSP remains watchful and remains ready to resume monetary actions as warranted by the data on the inflation outlook and domestic demand prospects. The focus remains on bringing inflation back to a path consistent with achieving the target. Future monetary policy actions by the BSP will continue to be data dependent and guided by evolving domestic developments, particularly the latest outlook on inflation and sustained economic growth. So thank you, and let me pause there.
Thank you, Deputy Governor Daquila. Next, we have DBM's Principal Economist, Dr. Joselito Basilio.
Thank you, Tony. On behalf of the DBM Secretary, Amena Pangandaman, good morning to our colleagues in government and to our partners in the private sector. The full year 2023 budget, the administration's first full year budget, was signed into law by President Marcos in less than 4 months last year, following its submission to Congress, making history as the fastest signed General Appropriations Act. Amounting to 5.2368 trillion, the national budget prioritizes programs under the 8-point socio-economic agenda and is anchored on the Philippine Development Plan. Determined to be an example of bureaucratic efficiency, as of June 30, 2023, the DBM has already released 90% of this national budget for the immediate implementation of these programs. We aim to sustain the country's achievements through various reforms. First, through digitalization. We have a digital transformation roadmap that will not only enhance bureaucratic efficiency, but also create a sound investment climate toward our agenda for prosperity. This year, we saw a milestone, the issuance of Executive Order number 29, directing the full adoption of the Integrated Financial Management Information System for all government agencies. This will ensure an increased efficient delivery of quality services to the public. Second is through inclusivity. Toward this end, the Philippines has already secured a momentous win for open governance in the country with the signing of Executive Order number 31. This one institutionalizes Philippine Open Government Partnership. This huge win puts the Philippines again in the spotlight, giving the world an example, a prime one, on how to institutionalize open governance. Third, by going green. For a resilient and sustainable economy, we have significantly increased the budget for climate change adaptation and mitigation, measures by about 60% for 2023. Through CCET, or Climate Change Expenditure Tagging, we will continue to monitor the scope and the distribution of climate action in our public expenditures. There are more, but all of these reforms will guarantee the continuity of gains from this year's priority programs and make the Philippines an ideal destination for foreign businesses and finance communities. Looking ahead, the national budget for fiscal year 2024 will continue to prioritize shovel-ready infrastructure projects, investments in human capital development, food security, and environmental sustainability. With the proposed fiscal year 2024 budget proposal already almost ready for submission, we hope to make history once again in the name of greater efficiency, accelerated transformation, and faster progress for all. It is the administration's fervent hope that this budget, the 2024 budget, will lay the groundwork for future-proofing the economy and making the country's growth inclusive and sustainable for Filipinos of today and generations to come. Thank you and good morning.
Thank you so much to our principal economist, Joselito Basilio. Listening to all of you this morning just makes me so proud to be a Filipino at this time. Congratulations. I think we should give our economic managers a round of applause for all they have done for the economy. Open government, climate change, the budget to address climate change has increased by 60%. They did 7.6% growth, which was the highest since 1976. It's just wonderful news everywhere. So congratulations, sirs. And so now may we ask the head of the economic cluster, Secretary Jokno. So yesterday at the State of the Nation address of President BBM, he said that collaboration is key. So after he mentioned that, of course, in just 1 year, he rattled off all of your achievements. With that phrase, collaboration is key, and we have members of the private sector here. What is the government's vision of PPP, and what are the points of alignment looking forward?
PPP, right? Public-private partnership. You know, within 100 days of President Marcos's term, we revised the implementing rules and regulations of the BOT law because there were many complaints that the private sector it's lukewarm. They don't want to engage into PPP because of certain provisions. So we amended that law within 100 days. And right now, we have approved under the new rules some 212 billion pesos worth of 4 projects. Okay, I remember the PGH Cancer Center. That's one. The other one is the the airport project, NAIA, was also approved. And then the Laguindigan Airport. And there's another one, Tiplex extension to La Union. We approved those 4 projects under the new public-private partnership within the Tiplex was approved within 10 weeks. That's a record. But the most recent one, the NAIA improvement, was approved in 6 weeks. Another record. So, given the new rules, I think the private sector will be encouraged to participate in public-private partnership. As I said, out of the 194 priority projects, around 30% of those will be funded through PPP. And now with the Maharlika Fund, I think that we can combine that, I think, also. Plus the recent amendment to the Public Service Act, that will really encourage public-private partnership in this country.
Sir, just to follow up, you already mentioned the Maharlika Fund. So just to explain to everyone or those who might not yet be well acquainted with it in layman's terms, what is the Maharlika Fund, Maharlika Investment Fund?
Well, as I said, out of the 194 projects, without the Maharlika Fund, 55% of those projects will be funded through official development assistance. So we borrow from ADB, borrow from the World Bank, some bilateral sources, and then another 10% will be funded through the budget, and then another 30% approximately will be funded through public-private partnership. Now, that's without the Maharlika Fund. Now with the Maharlika Fund, then we have another source and a different source of funding. It's a funding that will not put strain on our budget and will not put additional borrowing or burden on our people. And so that is the nature of the Maharlika Fund. Of course, every investment fund or wealth fund evolve over time, but to us, the priority use of that Maharlika Fund is to fund those priority projects.
Thank you, sir.
Thank you, Secretary Diokno. We received a lot of questions from the registration system, and we received one for the Bangko Sentral ng Pilipinas, in particular DG Francis, on the U.S. Fed's policy decisions. So how important is the U.S. Fed's policy rate in the Monetary Board's monetary policy making? If the Fed does hike 2 more times at 25 basis points by the end of the year, that would bring them to a top rate of 5.75% on the upper limit. Where is the BSP's policy rate likely to be?
Thank you. Thank you for the question. I think it's a question that's just in the mind of the market players here in the Philippines, but also in most emerging market economies. The first Fed decision will come in the last week of July, before the scheduled meeting of the Monetary Board on monetary policy, which will come in the middle of August. So by then we will have a number of observations on how the market reacts to the Fed decision. Now, what's good is that we have a number of improvements that we have introduced into our policy instruments that enhance the transmission of these instruments to market interest rates, including the introduction of a 56-day BSP bill. And right now, for the main policy instrument, which is the overnight reference rate, we have introduced still a fixed rate, but a full allotment auction, meaning that all be accepted by the BSP. And pretty soon, we will be moving to variable rate auction for the RRP. And all of this will serve to manage any reactions by the market in the interim between those two policy decisions. But having said that, of course, the Monetary Board will take into account all the market reaction and the implications of all of this on the inflation outlook and how that outlook relates to the attainment of the inflation target. Again, as I've said in the introductory PowerPoint, and as the board has been emphasizing in its monetary policy statements, that the BSP remains ready to act to ensure that inflation will be on a path that is consistent with achieving the target. Now, again, having said that, the environment today is very different from what we saw in the third quarter of last year, when the Fed was just beginning to undertake a series of very aggressive policy actions. And right now, the market is seeing that perhaps the Fed will do more before pausing. So it's a different situation with respect to the Fed, and very importantly, it's a different situation with respect to the outlook on inflation for us, for the Philippines. In the third quarter of last year, I can recall that inflation was still on an upward trajectory. And for some time, actually, we were thinking that perhaps the supply shocks are already finished. But we saw another spike in food prices in January of this year. But right now, inflation is firmly on a downward trajectory, and what we're seeing is that barring any new supply shocks, inflation will go down to within the target range by the fourth quarter, and in the first quarter of next year, actually it will hover quite close to the lower bound of the target, or it may even go a little bit below target during the third quarter before going back to close to the midpoint of the target. So, in short, the situation now is very different compared to what it was, and the board will, I'm sure, take that into account in coming up with the appropriate monetary policy action.
So it will be evidence-informed, including looking at changing conditions, especially looking at the difference between now and the third quarter of last year.
Yeah, everything's much better. I remember at the first Philippine economic briefing and the succeeding ones, we were always being asked about inflation, and we were always like holding our breaths. But now everything is really looking much more better. So with that, we move on to our NEDA secretary. How does the NEDA, as the primary agency responsible for economic planning and policy coordination, envision leveraging on the country's fast-paced economic growth to promote inclusive development, innovation? Yesterday po at the SONA, President PBBM talked about having a culture of innovation, and he called it Philippinovation, and also digital transformation. What is the NEDA's plan on leveraging the country's fast-paced economic growth to promote these?
Thank you. This is quite a difficult and question that requires one lecture. But to put it briefly, I think the challenge for this economy, for our economy, is to sustain growth over the medium term and over the long term to achieve economic and social transformation. Now, that requires nothing less than increases in productivity. But increasing productivity is not a manna from heaven. We have to invest in measures that raise productivity. And while economic growth per se will give us some elbow room for such investment, like investing in digitalization, in infrastructure, it also goes the other way. No? Such investment will sustain that growth because increases in productivity will allow the economy to grow over the long haul. So I think that's what we have put in place in the Philippine Development Plan. We have looked at how we can mainstream digitalization, we can mainstream inclusivity in the growth because there's a big space there for inclusivity because what we don't want is a growth that is exclusive, a growth that only benefits the few. We have seen that in our past and we have seen that in many countries, and when that happens, growth is not going to be sustainable. So inclusivity is very important. We have to invest in health, in education, in social protection as we allow the economy to grow rapidly, expanding the economic pie. So the constraints to making such investment are spelled out in the PDP. And as I said, digitalization is key to that because the current state of technology requires us to move the economy in that direction.
And if you would all like to view or read the Philippine Development Plan 2023 to 2028, just go to the website of NEDA. And of course, we would like to ask the principal economist of the Department of Budget and Management, what do you think are the key priority sectors looking forward?
Thank you. First, the proposed national budget for 2024 would amount to 5.768 trillion pesos, which is higher by 9.5% year on year and still equivalent to around 20 to 21% of GDP. So that means we have an additional 500 billion pesos in the next year's budget when compared to this year. And what would be funded? Primary expenditure directions will continue to be anchored on the 8-point socio-economic agenda. So that means we will spend on ensuring food security. The national budget will continue to provide increased allocations for DA's banner programs on prime commodities such as rice, corn, and high-value crops and fisheries, among others. And then there will be spending on reducing transport and logistics costs. And because government is determined to maintain high public investments in infrastructure at around 5 to 6% of GDP. The bulk will be allocated for physical infrastructure aimed at improving connectivity throughout the country through the construction of accessible road networks and railways. Significant funding support will of course go to social infrastructure such as school buildings and health centers. And then reduction in energy costs will be a primary expenditure item also. And that includes not only public investments in energy, but making sure that there will be private sector participation in investments in renewable energy. And then we have the most important ones, that the triple social spending. We have items to address learning losses because education remains the top priority as mandated by the Constitution, which shall cover around 15 to 20% of the fiscal year 2024 budget. And then improving health. Health sector will be supported by ample budget support to provide accessible and inclusive public health services even to the far regions in the country. and then strengthening social protection to support or provide banner programs such as the 4PH program for housing, which is a new one, and then food stamps in addition to the previous ones. The last ones would involve improving bureaucratic efficiency and ensuring sound fiscal management. So in the budget, there are no surprises. It is as predictable and as transparent as ever. The 2024 budget will aims to walk the talk in the SONA, and we can do that because the government finances is also sound and improving, as the President has indicated in his SONA. Thank you.
Thank you very much, Principal Economist Joselito Basilio of the Department of Budget and Management. We have a lot more questions, but we don't have more time for this panel. So please join me in thanking the members of the first panel. I hope the session gave everyone more insights on the administration's economic plans and priorities. Principal Economist Joselito Basilio, Deputy Governor Francis Daquila, Secretary R.C. Balisacan, Secretary Benjamin Diokno. And we will do our mid